Hi, everyone. Welcome to part 3, the final installment of Cannabis Accounting Best Practices to Minimize Taxes. My name is Allison Kirchhofer. I am a cannabis CPA, which means I have specialized training and knowledge to help cannabis businesses with all sorts of things, including navigating 280E, preparing for that inevitable IRS audit, and establishing rock-solid bookkeeping practices. In part 1 of this series, I provided an overview of accounting concepts and relevant tax codes to set the foundation. Part 2 walked through an example of cost accounting, which is the mechanism by which some cannabis businesses may be able to mitigate the punitive tax code 280E. Now, in part 3, I will review some best practices and provide food for thought. So let's dive in. First and foremost, best practices here, you need a chart of accounts that is designed to accommodate accrual accounting that is necessary. Hand in hand with that, keep in mind that good inventory numbers are closely tied to your cost of goods sold and therefore strongly influence your tax bill. So an inventory count procedure must be established. Now, if you're going through the exercise of tagging direct and indirect expenses anyway for allocation purposes, then I highly recommend including fixed and variable as well. Your future self will thank you. This is more for management use, so it's not related to the allocation specifically, but it can be very useful in measuring performance and KPIs and just gives you more slice and dice options. So fixed from a management perspective means uncontrollable costs, whereas variable is controllable costs. So you want to be able to break these out for internal reporting. Some more best practices here, fixed asset depreciation. This may be allocated as an indirect cost. So you'll want to have a system in place where you're tracking your fixed assets and calculating that depreciation so that you can include that in your inventory numbers. And I've got 2 tips on inventory valuation here. First of all, you're going to use the price paid when you, for example, get a bulk discount. And you're going to need to look at your shipping terms to determine whether you can include those shipping costs in your inventory. So if you're freight on board shipping as your terms, then that's COGS for the buyer, those shipping costs, because the buyer is assuming the risk. FOB destination is COGS for the seller. Now, I hope that up until this point, I was able to demonstrate how interrelated a company's accounting method and tax position are in the cannabis industry. And now I have some food for thought that you can take to go. Number 1, you cannot allocate everything to COGS. It has to be reasonable. So if you end up with $3,000 cost for a product that sells on the market for $1,000, well, that is not reasonable, so be careful. Now, number 2 and 3, these are expected trends over time. That costs will decrease as production volumes increase, and in the case of a grower, their growth cycles will impact costs. So what does this all mean for managers and business owners? Well, for growers, they will want to determine the fastest growth cycle and the highest level of production that they can achieve without sacrificing quality to minimize costs. For retailers, they're concerned with the ideal reorder point to lower costs of holding inventory. So an interesting point to be made here is that typically managers are incentivized to lower costs for a business, right? Whereas this entire series, I've been talking about maximizing costs for tax purposes. So effective management may actually increase taxable income over time. Let me say that again. Effective management may actually increase your tax bill over time. But that's okay. because this is an expected trend, which is something the IRS is going to want to see. It'll keep costs reasonable in the eyes of the IRS. And finally, here are just some additional considerations. And I'll preface this by reiterating a point I made in part 1, that allocating costs to COGS is not the best or the only tax position for THC businesses. In fact, it is more advantageous for growers and manufacturers simply because dispensaries and retailers, they have less direct costs to allocate. So a retailer may determine that a better strategy might be to apply costs to a non-cannabis division. Now, frankly, that is a presentation for another day, so be on the lookout for that one. But I will say this, a non-cannabis division better be, first of all, accounted for separately, second of all, profitable, and third of all, substantial. In other words, it's got to be a real business. And that about covers it. So if you are a license applicant out there or a license holder in the cannabis industry, I hope you learned something new. And if you find value in good accounting, please reach out. My email is in the description. And of course, please spread that internet karma with a like and a share. Thanks for listening.